afternoon and welcome everyone to the African bond market seminar. We're giving the time to all our participations to connect to our participants to connect to the seminar. So my name is Alessandro Lombardo. I am the head of the international department of the Cbonds company, and I'm really pleased to present and moderate this seminar dedicated to the African bond market. As many of you already know, our company periodically organizes conferences and seminars dedicated to the bond market in different countries. So in these events, all our speakers focus their presentations on the bond market, providing to all our users the possibility to acquire new information that can improve the knowledge in the bond sector in order to seize then for new opportunities offered by the bond market and maximize, of course, the portfolio performances. So today's seminar, which we have organized in collaboration with Financial Africa, will be totally dedicated to the African bond market. So our experts will give you valuable information in order for all of you to evaluate, why not, a higher exposure of your portfolio in the African market. During the seminar, we will present as well the Cbonds platform, which offers to all investors detailed information regarding the entire international bond market, allowing to detect all the best investment opportunities outstanding in the market. Now, it's time to raise the curtain and introduce you to our today's speakers. So welcome to Mr. Simbarashe Jindu, Sub-Saharan Africa trader at MeritKapital, Mr. Anouar Hassoune, credit analyst and Islamic finance expert at GCR Ratings, Mrs. Lana Veselova, my colleague Lana, international partnership manager at Cbonds Group, and Mr. Cedric Mbeng Mezui, financial system specialist. So welcome to everyone to this seminar. We are going to start with Simbarashe Jindu, and then we're going to continue with Lana's presentation, Anouar and Cedric. If we will have enough time, of course, we will try also to organize a discussion between our speakers. So feel free to send all the questions you have for our experts in the chat, which is available on the right side of the screen. So Simba, I think we can start.
Hello, everyone. Thank you very much for this time. And it's a pleasure again to be presenting at Cbonds, trying to help investors see a bit more into the space that we play in, which is Sub-Sahara Africa. So what's the state of play 2023 for Sub-Saharan Africa? So just an overview. Post-COVID, this is what we've seen Sub-Saharan Africa. The market hasn't grown as much post-COVID. I think post-central bank tightening, what we've seen is, I think, from an average of about 10 billion in issuances, equivalent US dollar, every year. I think for the past 5 years up to 2021, 2022 saw just 3 billion issued by just two issuers, Nigeria and Angola, and everyone else pretty much stayed out of the market. Then financial conditions just would not allow it. So the market is primarily US dollars. Most issuance is US dollar, give or take 80% of it. And the euro issues are mostly confined to your West African issuers, your Benin, your Senegal, and Ivory Coast. So I think coming from COVID, a couple of things happened. We saw a few changes regarding growth. We used to have some growth stars that lagged the likes of your Ethiopia, your Ghana. These generally were having economies grow as over 6%. They were really high growers, but then the effects of the COVID and all the other shocks that came afterwards, growth has moderated somewhat. But I think I should also mention here that Ethiopia, in spite of the war that's been happening there, is still averaging 5% growth post. So from 2021, 2022, growth is averaging just over 5%, which I think is very notable given the circumstances. And as well, I think it's good to mention Angola, which previously I think was going under quite a bit. They were struggling with growth, but now they seem to have turned a corner. Now the economy has turned positive. And on that note, I go on to a bit of country analysis, starting with the very same Angola. So in addition to what I've just mentioned regarding growth, debt as well was another very big bump for Angola. I think we were over 100% heading into COVID, and with the whole downturn in oil prices, the economy was really under stress. But fortunately for them, I think, for lack of a better word, they got over their pride and were able to tap into DSSI, which really helped them to get back on their feet. So now I think going into COVID, so I think the country was really doing well, currency strengthening, CPI was falling, buckling the norm that was seen in most other places. But heading into 2023 now, I think we've started to see some bit of concerns, obviously, as Brent has struggled to maintain the highs we saw in 2022. I think now we're averaging, I think it's been about the 70 handle for quite a while now. And given that their budget is set at about $75 per barrel, that was their price target on their budget. I think, that's why we've seen, if you can see on the chart, just comparing to a peer, Nigeria, I think for most of the period starting last year, Angola is now trading inside Nigeria, but recently we started to see Nigeria start moving inside Nigeria amid all of those concerns. But I would like to add that, okay, regardless of all this, we still think Angola still has quite a bit to offer to the space. I think the biggest thing, which pretty much covers most of the space, is that the IMF is still out there and willing to lend. And I think recently they increased their limits. I think you can now get funding for as much as up to 600% of your quota, which is, I think, really good for the likes of Angola, which just completed a program, I think 2021. So it means there's available financing in case they need to go there. And I think this is a story that's still developing and we're still positive on Angola. The next country I suppose focus with is Ghana. I think I mentioned at the start that this was one of the star growers in the space. Then COVID still maintains some growth, but the momentum has slowed somewhat coming post-COVID, and we've seen quite a number of bumps with the country locked out of financial markets. They defaulted last year, end of the year, and they've been restructuring. So they restructured their local bonds, and that went on well and paved way for the IMF to approve a deal in May. What I'd like to add on Ghana is the terms IMF has provided to them are somewhat lenient compared to, say, what you saw on Zambia. It's a change in wording, which I believe is very helpful in the cases of countries trying to restructure. Just to give a bit of background on the Zambia story, Zambia also defaulted. That was the first defaulter in the region. But what the IMF did was that they put wording in the agreement that for any subsequent reviews, the first one to be precise, the country had to have reached reached some form of understanding with creditors regarding restructuring. So there was a commitment from creditors, and a bit of, I think, politicking there among the official creditors. China, for instance, trying to really push to get multilateral lenders to, shoulder some of the weight, and pretty much China could veto any progress on any other disbursements from the IMF. So the IMF appears to have changed the wording somewhat on this. After, I think, about over a month since April, I think there was a staff level agreement. Zambia managed to get a disbursement approved, with the IMF just needing assurances. So I think that's in the positive light for Ghana, as well as the country looks to restructure their bonds and deal with the official creditors. So what you see now post that approval from the IMF is a bit of a pullback in the spread. I think we're very much in distressed territory, Ghana, with the 3,000 basis points above your treasuries, which is very much in distressed territory. We've put back a bit, some 300 basis points, but then again, just to show you that conditions are tight and it's no longer a given that IMF support, means a rebound in bonds. The bonds have not picked up so much. I think ever since the board approval, I think bonds have moved 7 or so points, and they're still very much trading distressed territory. Your low 40 handle, high 30, high 39. So it's an issue of a market not being too exuberant on the IMF deal. The country still has a long way to go, and as well, they've very low expectations of recovery. I think the good estimates, I think the ones that put it in a very positive light, see maybe low 50 recovery levels on Ghana. I think most of the market is looking at maybe your mid 40s. That's why you haven't seen a very strong pickup in Ghana post approval of the program by the IMF. I think just to give you a bit of context, Zambia, just after, it was living an IMF program, but just expectations that an IMF program was going to be agreed. The new government came in, I think, 2021, and within a couple of weeks of a new government coming in, you saw bonds trade from the 50-hander to up to about 80, so about 20 something points there. So that's the major difference that we've seen. The market is a bit hesitant to give the all clear to Ghana, but it's an interesting story we can possibly continue looking at. Moving on from Ghana, Ivory Coast. This is one of the very good credits in the space from a rating perspective. I think it's the highest rated in Sub-Saharan Africa. Outside South Africa, I think for the purpose of this core, South Africa is not included, but outside South Africa, this is a very strong credit within Sub-Saharan Africa, and one of the few countries to register positive growth in 2020. Most of the countries in the space really had a very tough year then, and they've maintained that momentum. I think growth is still averaging over 7%, 2021 and 2022, which is a very good thing. And as well, I think for Ivory Coast, the country does have very good institutional strength for them. They are part of a monetary union, which I think works really well given the conditions of the market. So they've been able to raise financing better than I think most other countries are pretty much depend on the locals to raising sort of financing. So for Ivory Coast, the regional central bank as well does play a bit in sort of keeping things a bit stable. So we like Ivory Coast, and yeah, even if you check, I was just comparing one bond on the long end and a 30, and I think a shorter end bond. Unlike most other African sovereigns, we didn't see too much of an inversion of the curve here in Ivory Coast. Spreads just about maintained what they were before central bank tightening, which is a good indicator of the strength of the name. And so I think done Ivory Coast, Kenya, the next one here. I think this was a very good credit as well. Good growth year on year, but as well as was the case with most of the space, it's they couldn't access any more financing when central banks started tightening. And I think the advantage for them was that they have very good support from the World Bank, IMF. They're on several programs. But even then, I think just about March, April, market became quite concerned about maturity war. So they have 2 billion bullet payment on a Eurobond maturing in 2024. And with very little access to financing, the market pretty much still has the jury out on whether they will be able to pay that out. The IMF, fortunately, seems to be really backing them up. They extended their program for a further 10 months and as well added a bit more to the program. The World Bank added another $1 billion to their program, which is, I think, positive for them. But even then, if you can see on the chart at the bottom of the slide, you see that you still have, I think the very first dot there, top left, that's your 2024s. They're yielding about 13% on a one-year paper. And you check the rest of the curve, we're averaging about 11%. So the jury is still out on this 2024 bond. So that's a story to be on the lookout for in case you were thinking of Kenya. But the market has, I think, has really appreciated the support of the World Bank. I think there's recent amendments. You've seen, I think you had the rest of the curve was trading about 13, your 27s, 28s, then the 13% yield handle. Now they've gone down about 2 percentage points, which is a positive. This is just in about a month's time. So something positive on there, but the 2024s, they may prove some form of attrition to the prospects for Kenya. And then moving on from Kenya, Nigeria, I think this one has been the star performer for the space in the last month or so. We are averaging about 12% return, and peers are nowhere close. What you've seen is a surprising pace of reforms, even from my end. The new president does seem to have a group of advisors who are keen on getting the country back on track. I think we've seen the subsidy scrapped, where I think the previous government had planned for a phasing only in July, but this new government came in just within a few days of the inauguration of the new president. The subsidy was scrapped, and more recently, just this week, it seems the foreign exchange system has also been liberalized. The central bank doesn't seem to want to play as much a role as the previous one in terms of fixing the rate versus other currencies. Yeah, so that's a positive for Nigeria, and we remain very constructive on it, even following this outperformance. But I think one thing I would be putting my eye on is revenue generation. So Nigeria is a major oil exporter. That's the source of most of the export revenue. And given where Brent is trading now, it's a case we need to always be looking at, given that the revenue base is not as diversified. So that's possibly one aspect you probably have to be looking at to see how reform in that space, whether the new government will start widening its tax base, given as well the challenges with it being majorly informal economy. Quite a significant chunk of the economy is in the formal sector. So that's one country we're really liking, Nigeria, and we're still constructive on it, even given the recent outperformance. And so we, just to wrap up, look at some bit of recommendations. I think what you see mostly for Sub-Saharan Africa is that the space has very much lagged, any sort of recovery you've seen in other spaces. Right now, we're expecting Fed tightening, for example, central bank tightening in general, to come to a pause. I think we have just a few maybe expectations that we don't have much to go on the hiking cycle anymore. So if you look at the first graph up there, that's your average Sub-Saharan Africa sovereign spread versus treasuries, and then you compare that to US high yield corporates. And you can see that since US high yield spreads on US high yield are just about trading where they were before this period of central bank tightening. So it's just about stable on that front on high yield US corporates. Whereas for Sub-Saharan Africa as a region, was still lagging some 300 basis points from what the space was at the start of this hiking cycle. So that said, obviously there are some names, some credits that have had stories turning from good or average to bad. So not wholly recommending all of it, but within the space, there are definitely some names we can look at. And looking at the chart at the bottom there, so what you have there is your average Sub-Saharan Africa versus, say, Nigeria, the spreads, as well as Ivory Coast. So these are the names we are really keen on at the moment as a whole. Nigeria, we're about, I think, give or take, about 100 beeps still to tighten. And we believe even given this recent rally, there's still some names that have lagged. Single out the 38s, for example, if you're looking for something a bit on the long end. I think that's as long as we can recommend your 38s. They generally tend to lag most of the rallies for some reason, and you more often than not find them still trading quite cheap, as is the case now. I think your 38s are just above 11% yield, whereas you have your longer tenors, your 49s, your 51s, just about at the same level. So that's something perhaps can look at on Nigeria. Ivory Coast, I also put it here as primarily your defensive name. It hasn't returned anything close to what we're seeing on Nigeria, for example. But why keen Ivory Coast is that generally through amidst all the volatility you generally see in the space, it tends to remain quite stable price-wise. Very little movement on prices on Ivory Coast. And just checking the chart as well, you can see that Ivory Coast is just about trading at the same level it was spread-wise before the central bank hiking cycle. So that's why we're very constructive on Ivory Coast, and we especially like the 32s on there. They also seem to be lagging the rest of the curve, and that's something you can possibly look at just for a trading idea there. I think, yeah, that was the end of my presentation. Hopefully you can get some questions that I can try to respond to your queries. Thanks, Alessandro.
So now we are going to start with my colleague Lana Veselova, a quite detailed presentation of the Cbonds platform. In this moment, Cbonds is one of the two most comprehensive international database on the bond market with information on over 700,000 bonds. And it can be very helpful also to look for information about interesting African bonds. So let's start. Lana, please.
All right, so you will be able to have my presentation in terms of how to find high yield bonds and how you will be able to track them. As some African bonds, they give pretty interesting yields, and not all of them are in default. So I would say it's not only a special case situation. So let's start. Let me introduce Cbonds platform, which is cbonds.com. Here you will be able to basically improve your efficiency in terms of finding some interesting bond investment ideas, and you will be able to basically pass all the compliance because you can find detailed data on each bond, as well as to know all the terms. Cbonds covers around 700,000 of bonds from any country, around 200. So we also are basically specialized on emerging market, and African market is very comprehensively covered. As well, you will be able to find some information on stocks and ETFs, although probably this is not the topic of our discussion today. I would like to present you the most powerful screener, which will help you to find those bonds which match your demands. Today, you were already able to see some snapshots which Simba was using in his presentation, but let me show you how you can find bonds according to your criteria. So in section bonds and bond search, you will be able to apply different filters, and you can find those bonds which basically match your criteria in terms of yield, rating, coupon. As you can see, there are multiple filters in terms of duration, the currency, the rating, the type of the bond. You will be able to search for particular type of the bonds, so you can exclude them. You can put the filters in terms of the pricing, the coupon. So let's try to make some overview of sovereign bonds from African market and issued in hard currency, in USD. Basically, there are different types of yields. So let's start with the 5 and with some duration starting from 1 year. You will be able to filter according to investment grade, for example, or lower. But let's just keep it simple, and we can find those bonds which have fixed coupon. So you can see those filters which I applied. We found 101 bond, which perfectly match my demand, which is high yield, starting from 5%. You're able to visualize your search results in a convenient way, export all this data in Excel, and then do your magic, analyze bond data in convenient and structured way. So you can have around 60 descriptive parameters and the last pricing data. So you can just sort later on and analyze in those mode which you are interested in. And very interesting feature is to ability to visualize your search results on the yield map. That's basically how you can visualize all sovereign bonds, and you can see which market is giving really high yield. As of now, this is Ghana. But in case you would like to enlarge some part of the chart, feel free, and then you will be able to basically analyze only those duration you are interested in. In case you like the bond, you can simply just click on this dot, and then you'll be forwarded to the particular bond page where you can find all details about this particular bond. So you can see this is international bond from Ghana. You can see its type, the latest ratings from Moody's, Fitch, and S&P. You will be able to use our tools in order to calculate yield to maturity, yield to call, accurate coupon interest, dirty price which you pay basically to the broker, PPP, convexity, and all these difficult things in case you really need. We store prospectuses in final terms, so you will be able to pass all the compliance, and in case you deal with some special cases, this is really something crucial for you. As of now, you can see the trading chart. This is dynamics of price. We store historical quotes for sovereign bonds about 30 years depth. And you can just change the duration you would like to analyze. So I would say 1 year or 2 years would be more than enough for you. So you can see how the price or yield as of now will be changing within some time. So this is dynamics of yield. You can switch to also T-spread to US Treasuries and see where this bond is standing in terms of the benchmarks. You can enlarge the chart with a particular duration in order to basically analyze, and you can just visualize also the yield map of this issuer. You can also just choose, maybe there are some other positions which are giving better yield. Just enlarge and you can see in a proper yield duration scale. Below the chart, you'll see the sources of prices, and we operate as a data aggregator. So there are around 350 pricing sources among stock exchanges and market participants. So you can see intraday quotes and end of the day quotes and OTC market participant quotes, which is really crucial because you need to understand what is the fair market price for each particular bond. And you will be able to get the historical quotes. You can export all this data in Excel. Just read more about particularly issuer. In terms of some sovereign bonds, we'll just revert a bit later. You can see the cash flow in case the bond, the issuer didn't pay the coupon. You can see the, all the terms, some technical default. You can see all the information maybe about the additional tranches of this bond, all the identifiers, current ratings. We also analyze prospectuses and state covenants. So this is basically your insurance. And you can see the list of institutional holders. These are the funds who hold this bond in their portfolio. You can read more about maybe some analytics which is attached to this particular issuer. We are at the issuer page where you can see their yield map and probably some indices which are related to particular issuer. So as of now, we can visualize some sovereign yield to maturity index. As well, we provide different CDSs, inflation rate, and other indices which will help you to understand the dynamics. You can see the debt breakdown in different currency, the current and the historical ratings, so you can just make sure the quality of this particular issue. In case we analyze some corporate issues, you will find also some historical quotes. Then let me just introduce you some parameters, so you will be able to get the access to this platform in terms of the web access. So this is very easy solution. You can be flexible, you can fly anywhere you are. Cbonds will always travel with you. We also have different tools such as Xceladin mobile app and API, which is a structured solution. So as you can see on the bond page, you will be able to see all the descriptive parameters, the pricing, the prospectuses, ratings, financial reports, and the cash flow. In terms of the quotes, let's summarize. So we provide the quotes from around 350 pricing sources. These are all world stock exchanges. We provide end-of-the-day quotes and also intraday quotes from German stock exchanges. We provide OTC quotes, so these are basically brokers, banks who are ready to trade the bond, including MiFID disclosure and FINRA disclosure. So these are OTC quotes from Europe and US, so you can know how the market evaluates such bonds. And we also calculate Cbonds estimation. This is average market price, which helps you basically to know the fair market price for your bonds. We also provide the solution to track your bonds, to track the dynamics, and basically helps you to stay updated on your portfolio automatically, so you don't need to always check some information. You can just receive alerts according to your preferences. So let's see how you can add bonds into your watch list. So you can basically follow bonds, also stocks and indices. This is very interesting that you can just track everything automatically. You can structure all the bonds, for example, in particularly groups. So you can group them as sovereign bonds according to the currency you are interested in. If you do the portfolio management for your clients, just name according to the clients, or just as you prefer in terms of credit rating quality or not. So you can see the price yield changes. You can see them updated automatically every single day. You can set alerts according to the bond events like coupon payments, call options, redemption, changes of ratings. And one of my favorite features, you can also, by the way, you can check some historical values in order to see the dynamics and probably evaluate your portfolio historically. As well, you will be able to visualize and use our bond screener, I would say bond map, in terms of your watch list. So you can just see which bonds that you have chosen give you a better yield. Just enlarge and you will see. So I would recommend to probably not to super diversify with the currencies, but it's up to you always. And you can follow your watch list. I would like to also introduce you another tool which we provide for, I would say, more advanced way to track your portfolio effortlessly. You will be able to manage your portfolio and obtain all our information directly in your Excel, which is convenient because you can update and the codes and the yields and the data via formulas. You can just visualize some functionality which we already provide in Excel. And I personally track, for example, CDSs directly via Excel add-in. So you can track maybe some bond yields via this particular tool. So we have the solution not only for Windows, but also for all, Office 365. You just have all the guides in order to install everything. So you can see the sample, how you can basically create your portfolio. You can have extra tab in your Excel, and you can just build some formula in order to get Cbonds functions. Here we can make a simple formula just to retrieve the bond name. But we can make different formulas in terms of obtaining some indicative price or indicative yield, duration, maturity, call option. You just apply the ISIN number, the date you would like to get the value, and the trading floor. And that's it. You just need to make the format of your file properly and see that you can receive indicative price. Here we will try to get the formula for indicative yield to maturity. So again, just the ISIN, the date, and the trading floor. And then you just apply your formula to the whole row. And once you open this file, it is always be updated according to your particular preferences, how you would like to build the file. So as I already mentioned, you can follow stocks, ETFs, and some indices. As you can see, I had some spread. So we have additional tools, so you can just open the bond page directly without visiting our platform. And again, you just visualize the bond page. So this is a short video of how this works. We also have a convenient mobile app. It allows you to stay flexible and always get updated in terms of your portfolio, or just quick access to the bond quotes. There are different clients which prefer to stay updated and find some rare information via our platform. So we will encourage you to start your free trial of our platform, and you will be able to explore all the market possibilities and probably find some the most appealing bonds according to your bonds, which are not available at any other sources. Just checking those insights which you have received today from our experts. Well, basically that's it. In case you would like to have some questions, I'm happy to answer.
Thank you very much, Lana. So, of course, if you want to start your free trial, feel free to contact us. We just sent also all the contacts in the chat, so you can see our phone number and our email address. But let's come back to our seminar. So I'm going to welcome Mr. Anouar Hassoune, as credit analyst and Islamic finance expert at GCR Ratings. And the name of the speech will be the title of the speech, The African Risk as it is Perceived in the International Notation Process.
This is a credit rating agency's perspective. A couple of words about ourselves before we start. We are GCR Group, the only Pan-African credit rating agency. We were born 25 years ago, and we rate 700 plus counterparts in Africa out of 30 countries. We have 5 offices in South Africa, Nigeria, Kenya, Mauritius, and Senegal. And we belong to Moody's since last year. And if you're interested in African credit in both local currency and foreign currency, then feel free to talk to us and to reach out. We'll be more than happy to answer your questions. I am not going to enter into the specifics of each country. We have, as you know, 50 plus countries on the continent. So if we have to discuss a few countries, we can during the Q&A session. But I'm not going to go through a few of them, otherwise it's going to take too much time. The first starting point is that, as you know, country risk in Africa is high and it's not getting better. It's stabilizing roughly in the sovereign credit space in the double B or single B category, with very few exceptions: Botswana, Mauritius, and some MDBs. What really drives the private sector foreign currency credit rating is compression. As you know, most rating agencies tend to cap the credit ratings of private sector issuers to the level of the sovereign or close to it. And therefore, my objective in this presentation is to try to convince you to start digging into the local currency and regional currency bond space under certain conditions, which I'm going to try to explain and make concrete. One thing that you probably know, if you don't, then maybe we should focus on this item very specifically. The fact is that debt levels in Africa are not high, and this is not the main credit factor that drives the credit ratings low. The true reasons, are a combination of security threats in a number of areas, the Sahel, but also Central Africa and also Eastern Africa. That's number one. Number two is governance. So we are focusing quite heavily on the governance indicators, especially those of the World Bank, and a combination of a lack of competitiveness and a lack of attractiveness. One example, when Ghana defaulted, its debt to GDP ratio was 78%. True, 15 years ago, it was only 25% of GDP. But 78% at a time of a default is not a high figure by any means. The reason is foreign currency. The foreign currency drivers of debt is what really puts a constraint on the debt sustainability as measured by the IMF and the rating agencies. So the question becomes, how is it possible that a rating agency measures the capacity of a country going forward to improve competitiveness and attractiveness? And the first answer to that question is about competitiveness. The competitive position of our countries on our continent is a price leadership, certainly not by quality. And therefore, prices of imports and exports play a critical role. And the rise of inflation is not good news by any means. Let's get into this for a moment, and then we'll dig into the attractiveness variable. So the price elasticity of exports is extremely high. So one thing that we focus quite massively on is the ability of a given economy in Africa to extend its value add by industry in order to reduce the price elasticity. Formation of prices to a large extent in the primary sector is exogenous. And therefore, most African countries are price takers and certainly not price makers. Competition is very high, especially for agriculture. Example, the palm oil that is produced in Ghana, but also in Ivory Coast and some other regions, are massively being competed by the Asians and the Latin Americans. Vulnerability to demand shocks, we saw that during COVID, and limited incentives for value added or value adding investments. This is where our focus is, and we'll talk about it in a minute. So if you look at the African competitiveness indicators, agriculture is still, just like in the 90s, in the 2000s, in 2010, very massively contributing to the capacity of a given country to generate foreign currency to pay back debt. So it's not so much the budget and the debt that is at stake, it's the capacity to convert value into foreign currency. And the continent is trading the global game to a very large extent with very few exceptions. South Africa is one exception, Botswana is another exception, and Morocco is a third exception. Mauritius is an outlier because it's a small service-driven economy rather than a primary sector economy. So what is at stake really, and what do we focus on in order to try to figure out the trajectory of a credit in both local currency and foreign currency? Is investment in physical capital, human capital, technology, and institutional capital. And as you can see, the red and orange dots either enhance competitiveness or attractiveness for foreign currency increase at the central bank level. How can it be done? Well, usually we focus on reading extensively the national programs for development, and the national programs for development usually give you a very clean vision of where investments are being headed: education, physical investment, research and development, but also governance. And most of it is directed towards the transformation of the primary sector, mainly agriculture, into the agro industry, but also reducing the bureaucracy, increasing the technical skills, and digitalizing as much as possible. So at the end of the day, if you look at the way we perform our credit analysis, be it at the sovereign level, but also in the private sector, we focus on governance, on the doing business indicators and the human development indicators far more than on the debt numbers. The debt to GDP numbers would not tell you the full story. What really, really matters is the extent to which a country is capable, given its investment strategy and enhancing its indicators of governance, doing business, and human indicators, to attract more foreign currency by exports, but also by foreign direct investments. And if you look at our countries, it is obvious that, yes, improvements have been made, but still, in terms of governance, we're lagging. In terms of doing business, we're lagging. In terms of human development indicators, we're also lagging. And this is where most of the investments are being done in successful countries. Look at Morocco, Rwanda to a certain extent, up to lately, Botswana, Tanzania, Namibia, and South Africa. So I'm going to skip this. And at the end of the day, what really matters is to see that if we are betting too much on the foreign currency denominated bonds, we're not getting the full story. So what I'm going to try to do here is probably not to convince you, but at least to start initiating the conversation on maybe digging a little bit further into the local/regional currency denominated debt in the areas that matter to the African economies and under some conditions pertaining to the foreign currency risk hedging. So let's get into it. If on the left-hand side, investors focus too much on foreign currency denominated debt, then the compression of the credit rating will not give you the full story. between single B denominated debt, single B rated debt, and double B rated debt, you will get stuck into a universe that doesn't really differentiates between the real winners and the losers. So maybe the local currency debt will probably give you something more in terms of information depth. Let's get into it. Where does it matter? Well, if you look at the average person on our continent, the average age is 20. 50% of the population is less than 20 years old. And the needs are basic: water, food, housing, transport, energy, education, health, and services, and especially digital services. So the private sector will be and is actually the main contributor to providing this person with all that really matters. So at the end of the day, agriculture is the main enabler. Mining will probably also contribute massively to foreign currency capacity, but the agro industry and the transformation through value add will not be something that will be driven by governments. It will be driven by the private sector. And the private sector does not issue bonds in foreign currency. All right. And what is quite interesting in the way we look at it is that the basics of natural resources are there in order to supply the push. For example, in terms of cobalt, chromite, uranium, platinum, the continent is the key supplier of all these essential products for the industry. So on the basis of this, plus the agriculture, the four main drivers of foreign currency capacity is industry, infrastructure, consumer goods, and services. And what we have witnessed in our work, providing credit ratings to companies more than sovereigns, is that you will find in the local/regional currency bond market issuers that are worth looking at. And especially those private sector entities rated in local currency, which are exporting to the three main areas of exports: China, the US, and the European Union. So now the question becomes, if the bond market is interested in moving step by step away from the foreign currency denominated debt issued by governments, there is a universe that is close to it, but not exactly the same as the one previously mentioned. That is the local currency private sector debt issuers, which are and will be increasingly the driving forces behind Africa rising in the bond market as a future star. So this is exactly what we do. We provide credit opinions on, out of the 700 credit ratings we provide, 95% of them are private sector ones. And these entities will not issue Eurobonds before at least a couple of decades. And therefore, if we have one message to convey to you, is to start looking at those, provided that the foreign currency risk is being evacuated. One example, West Africa, French-speaking West Africa. The currency of French-speaking West Africa, as you know, is pegged to the euro. There is little probability that this will change in the foreseeable future. There is a natural sort of hedge, but there is a drawback. Some of the credits there, and I will mention a couple of names, Sifka, for example, in the agro-industry business, and Sonatel in Senegal in the telecom business, are very strong credits in local currency, probably not in foreign currency. These credits are attractive from a probability of default perspective, but also from a yield perspective. One drawback, though, is the liquidity. Bonds in our markets are quite illiquid. So if the liquidity issue is not at stake, then the message, once again, we would like to convey is start look at them. They are quite fascinating and quite interesting credits to look at beyond what the sovereigns have been used to doing in issuing Eurobonds. So that was the message. I only have one message, and all those slides had as an objective to provide and convey this message to you. Alessandro, this is the end of my presentation, so back to you.
I am very, very happy to have you as a guest today. I hope to see you soon also in other webinars. So thank you very much again. We can continue now with Mr. Cedric Mbeng Mezui. Cedric. And Cedric's presentation will be based on the African domestic financial market. So Cedric, a word to you. Thank you very much.
Here, actually, since 2017, we have been able to speak about the risk of seeing some Eurobond to become a bomb debt for African economies. I call them Eurobomb, actually. Many reasons for that. By compiling data between 2007 to 2017, we found a gap between the fund raised on the Eurobond market and the volume of investment in few countries. In addition, we reviewed the level of readiness of the project in the Eurobond prospectus. We found that many of them were still at early stage of development, which means that they were not ready to absorb the funds mobilized. In some cases, the fund mobilized were sitting at the central bank waiting for the project allocation for months. This was an alert on potential risk on debt services for some of these economies. Let's look at the dynamic of the spread against the US since COVID, taking here the Standard Bank Eurobond Index. In addition to Jindu's presentation, it appears that market conditions have really changed for most of the economies. The COVID-19 led to a rise in spread with a peak in March 2020, an average of 1,100 basis points against the US Treasury. This was the highest level compared to all regions of the world. This is the average, but for some countries, it went up to 40%, 38%. And it has been noted that the oil-producing countries of Africa are more vulnerable about the volatility of the price of oil and its impact on the fiscal space for these economies. If we look at the next slide, another shock posed by Russia-Ukraine conflict. Eurobond yield had risen again, notably for most of the economy soaring due to, firstly, geopolitical concern, and secondly, tighter global financial condition. In line with Anouar's presentation, this supply shock represented another catalyst for African economies to understand the importance of boosting local manufacturing capabilities and sustaining trade among each other. We could see that the implementation of the African Continental Free Trade Agreement may now be reviewed with an intent to accelerate trade among partners on the continent. The third shock on the next slide. This is since last year, we see the quantitative tightening, or we call it also a balance sheet normalization from Fed and ECB, all affected the yield on African Eurobond as well. If we look at the entire existing portfolio of 48 Eurobond securities issued by African countries, The following point can be actually noted, as you see. An increase in the spread of the entire portfolio for 41 Eurobond out of 48. An increase in securities rated in categories C and D, near default and default for 18 Eurobond out of 48. Let's turn to domestic. In line with Anouar, I fully agree with him. Within Africa, domestic bond market are still growing, and regulators are recognizing the need for local institutional investors to diversify their investor base. The continent is experiencing the most rapid urbanization rate globally. By 2034, Africa will have a larger working age population than China or India. This is an expected positive trend that will impact the development of local bond market, as mentioned by Anouar, and fully agree with him. Let's look at the numbers on these 10 countries. These 10 countries represent more than 80% of the African market value, which is close to $500 billion. I'm talking here about the local market. Outside of these 10 economies, most of the market are still at nation stage, with T-bills representing close to 70% of the bond issued on the continent. Yields are relatively high, as you can see. Look at Egypt and other countries. Double digit in several countries. However, inflation remains high as well. This results in higher issuance costs as investors demand higher yields to achieve real rate of returns. The good news is that when we factor FX movement vis-a-vis the yield, so total return is positive for most of the market. Can we look at the last slide? Next. We see that the continent, even we notice important growth in the last 20 years. There are still some challenges on the market development. 5 points. Access is still an issue: liquidity, transaction costs, risk return asymmetry, regulation. To address these challenges, it would be good to look at the intervention of multilateral development bank and development partners in supporting local market and debt managers. For example, the African Development Bank has set up the African Domestic Bond Index Family, BADBC or DBDX. It provides a benchmark for investors to measure the performance of African local market. On top of that, they design and structure the first African multi-jurisdictional fixed income ETF, the African Domestic Bond Fund, known as ADBF, listed in dollars terms in the Stock Exchange of Mauritius and dual listed in Botswana Stock Exchange. This is actually a game changer as it addresses perception and challenges that create barriers for investors to commit to local currency fixed income in Africa. It is structured in a way that answers investors' concern. I can mention other initiative by AFC, the bank, and over DFI issuing local currency bond in Africa to finance some project. It brings visibility to the continent and help to mobilize long-term capital. I will stop here and thank you for your attention. I'm happy to have your feedback and inputs.
Thank you very much, Cedric. I noticed that you already had an interaction, a written, let's say, interaction with all our participants. So I think we can conclude this seminar here. I would like to thank you once again, all our speakers. It has been really interesting today because very often the African market is not very popular, let's say, among European investors, but maybe just because of the lack of information. And Cbonds aim is the one really of providing information from all the markets. We work a lot in emerging markets, so this is one of our initiatives. Thanks again to all the speakers, to all our participants. So see you soon in Cbonds seminars, and have a great day, everyone. Bye-bye.